I think by now people are kind of realizing for the first time, for many, the first time, that printing money doesn't work. And that's their only solution they got left.
Economic crises are common expressions that most of us have heard daily in today's world of economic uncertainty, such as rising inflation rates and so on. Robert Kiyosaki, a well-known American entrepreneur and financial educator, recently predicted an approaching economic disaster. In this video, we'll go through everything in detail. Who is Robert Kiyosaki? Economic downturn warnings are typically taken seriously since regular monitoring of market conditions and economic trends is still essential for business performance. And since this warning is coming from Robert Kiyosaki, they are worth paying attention to. As most of us are aware, Robert Kiyosaki is a well-known American businessman who gained notoriety as a result of the success of his best-selling book, Rich Dad, Poor Dad, and his distinctive viewpoint on achieving financial independence and building wealth, notably in the real estate marketing industry. He has earned a reputation as one of the top financial gurus thanks to his skills in the finance and marketing sectors and his numerous entrepreneurial ventures.
There's a lot of it just mismanagement of debt and printing money to solve problems and all this. And we're now in a triple bubble. We have a real estate bubble, stock market bubble, and bond bubble.
You all agree, don't you? What specifically did Kiyosaki imply regarding the upcoming economic crisis? While Robert Kiyosaki has been talking about an imminent economic crisis for some time now, one that got most people's attention was his recent statement on Twitter. He wrote in a tweet, "I don't play the stock or bond market," adding that although he enjoys investing in anything he can get his hands on, there are many indications that the stock market is in decline. He voiced his worries and advised people to exercise caution and seek expert counsel since he believes depression might be on the horizon. Doesn't that sound cautious and unsettling? The stock market has done well this year, even though academics may disagree on the signs of an impending economic downturn. Compared to the S&P 500, the NASDAQ composite has increased by 35%. This is because investors anticipate that businesses will be more profitable in the future AI era. Others express concern about the potential dangers of excessive AI use. Robert Kiyosaki's most recent tweet left unclear the reasons for his conviction that stocks would decline and a severe, protracted economic disaster would follow. Nevertheless, he foresaw a collapse in stocks, bonds, real estate, and gold in May 2021 due to the Federal Reserve raising rates to combat inflation. Although he was right about the rate increases, asset values and economic growth have remained strong despite rising borrowing costs. However, the globe is still in motion, therefore, his predictions have more time. So let's look at indicators that could impact the likelihood of an economic catastrophe in the current state of the economy, even though we all hope that he is wrong about his predictions. But let's first define what an economic crash is. An economic crash is a sudden decline in economic activity, such as a fall in the GDP, the loss of jobs, or a decline in corporate investment that triggers economic collapses.
Okay, what happens? So all of this stimulus on top of the greatest demographic boom in history, but which did start to fail. So all this stimulus throws money into the economy. What do governments do with this stimulus? They buy financial assets. They start with bonds, but the more money goes in bonds, it will trickle into higher valuation stocks and real estate because that's where the returns are.
It is usually expressed during recessions and depressions. Recession is a minor economic decline that lasts for 6 months or 2 consecutive quarters with negative GDP growth. Contrarily, a depression is characterized by a severe and protracted economic slump that has a long-term effect on several economic variables. High rates of unemployment, abrupt decreases in GDP, bank failures, and asset price deflation are characteristics of depression. If you've read your history books, you already know that the United States has seen several big recessions and one significant depression. I'm referring to the COVID-19 outbreak, the Great Recession, the recession of 1980 through 1982, all of which required major government action. Now, let's look at the primary factors that can lead to an economic crash. Financial crisis. Economic declines are usually caused by financial crises, such as stock market crashes, asset bubble collapses, or bank failures, frequently leading to economic deterioration. These have repercussions on investment, financing, and overall economic activity. Macroeconomic imbalances. The economy can become unstable due to excessive debt, inflation, or trade deficits, leading to recessions or depression. Fiscal and monetary policy. Inadequate government response to economic challenges or improper management of central bank policies can exacerbate economic crises. Global economic factors. As the world grows increasingly interconnected, political unrest, trade snarls, or money woes in one area could exacerbate financial crises elsewhere. These important factors are also indicators of the state of the economy, which might affect future recessions and depressions. What do you think about the economy right now? Economic indicators that are both favorable and negative include rising inflation, meeting GDP estimates, slower than expected GDP growth, and an issue with the cost of living. Others are concerned about the economy despite the optimism of some economists. When we assess the state of the economy, there are signs of an imminent recession. Central banks, notably the Federal Reserve, sharply raised interest rates to stop 2022's inflation from spiraling out of control. Things have hardly changed by August 2023. With unemployment remaining historically low and inflation down to 3%, the second quarter's GDP expanded at an annual rate of 2.4%. There is still concern about how higher interest rates would influence consumer spending, which is a major driver of the U.S. economy, even though the Federal Reserve has moderated the rate of rate hikes. Consumer spending, unemployment, and job creation should all be constantly monitored as potential recession indications. External factors like the Russia-Ukraine conflict and persistently high oil prices could negatively impact the world economy. Possible results of Kiyosaki's predictions and their potential impact on different aspects of society.
Asset prices go down eventually, which they aren't yet, the government will let. When they do finally crash, they're going to be able to invest at more reasonable prices again and be able to invest for retirement. I tell you.
In May 2021, Robert Kiyosaki predicted that the Fed would raise interest rates to fight inflation, which would cause stocks, bonds, real estate, and gold to fall sharply. If you recall, this prediction came true. Could the resiliency of asset classes decrease as the rate hikes take effect and finally bring them in line with his predictions? Let's examine his reasoning for making this claim and how the federal government's increase in interest rates may cause each asset class to decline. In terms of stocks, increasing interest rates could result in the cost of corporate loans increasing. This may result in increased borrowing fees and a potential decline in business profitability. As a result, stock values can decrease. Bonds are another asset to consider. Newly issued bonds often yield higher when interest rates rise. Existing bonds with lower yields can lose their allure to investors. As a result, bond prices could decline as investors look for better returns elsewhere. Thirdly, rising interest rates may directly impact how much it will cost to finance real estate deals. This may make housing less affordable and decrease demand, lowering real estate prices. Lastly, gold is generally viewed as a safe haven asset that investors rely on during difficult times. Other assets, like bonds or savings accounts, may become more alluring when interest rates rise due to the potential for greater returns. As a result, gold's price may decrease due to decreased demand for the metal. He emphasized in his most recent tweet that even a dip in economic stock could trigger a chain reaction that results in a total or severe economic calamity. Fortunately, they haven't yet played out, or we'd be in for an economic roller coaster. So, while having an upbeat attitude is a good thing, having doubts about Kiyosaki's prognosis isn't entirely bad either. It has a probability of above 60%, and the effects on society might be horrifyingly negative. So, what would happen if there's a collapse in the stock market? Diminish wealth effect. Stock market losses erode wealth, which lowers consumer spending and business revenue and may lead to staff reductions. Reduce business investment. Stock market crashes can weaken the financial sector's stability by impacting banks and other institutions, limiting lending, and triggering a financial crisis. Weakening financial sector stability. Falling stock prices may erode corporate confidence, resulting in fewer investments and slower economic growth, reducing business investment.
You invest today, even with no predictions of up and down economy, you're likely to make, a couple % a year for the rest of your life. You're not going to be able to retire profitably until the markets come down to reality and you can invest at fair asset prices.
Increases sentiment and drowns confidence. Investor sentiment and consumer confidence are both impacted by crashes, which can lower economic activity. These elements can cause a recession or depression in the economy. You can tell that Kiyosaki conducted thorough research before making his assertions. Let's hope that his predictions remain predictions. It's crucial to watch for impending crises and plan to secure your money and investments to defend against these risks, as they can potentially impact your business negatively. What are these crucial indicators that you should be on the lookout for? Economic indicators. Keep an eye on the economic indicators we covered earlier, such as GDP growth, employment rates, consumer spending, investment activity, interest rates, financial market performance, and global trade. Look for significant reversals of historical trends or long-term declining tendencies. Consumer behavior. Watch for changes in consumer behavior and purchasing patterns. Increased savings rates, lower demand for non-essential goods and services, and decreased consumer spending can all be indicators of economic instability. Business performance. Keep an eye on how well businesses in your sector are doing. Financial issues, declining sales due to business failures, inventory accumulation, and layoffs may be signs of more serious economic issues. Market turbulence. Monitor the stock market, bond yields, and currency rates. Increased volatility and abrupt, protracted drops may be signs of economic uncertainty. Investors and policymakers can take proactive steps to lessen the impact of market volatility by analyzing and understanding its sources and effects. Changes in policy and regulation. Keep abreast of adjustments to governmental policies, regulations, and financial initiatives. These may affect market dynamics, business operations, and consumer behavior. International developments. Global issues such as trade disputes, geopolitical tensions, and significant economic problems in other nations should be considered, as the effects on national economies may be contagious. Then there are the necessary actions that must be taken in light of these economic uncertainties. Emergency funds. Build an emergency reserve that can cover 3 to 6 months of your living expenses.
And how much money do you have for savings? And the best way to think about that is to think, how much money do I spend each month? And how much money do I have saved? How many months am I going to be okay without that? And to value savings, right? Because savings is freedom and security, and think about what that is.
The money could act as a safety net in bad financial times. Diversify your investments. Spread your investments among various asset classes, stocks, bonds, real estate, etc., and industries to reduce risk. In a downturn, diversification can help reduce possible losses. Review your investment portfolio. To ensure your investment portfolio aligns with your financial objectives and risk tolerance, constantly review and rebalance it. Consult a specialist if necessary. Debt management. Take control of and reduce your debt. Pay off high-interest debts first and refrain from taking out additional loans during turbulence. Budget planning. This involves creating and following a budget that records income and expenses. Identify areas where discretionary spending can be reduced and allocate more money to savings and debt repayment. Insurance coverage. Examine your insurance coverage, including your health, life, house, and auto plans. Ensure that you have enough insurance to safeguard both your valuables and yourself. Consider diversifying your income streams. Look at side businesses or part-time pursuits to vary your income sources. Having extra money could protect you during economic downturns. Stay current. Keep abreast of recent economic developments, business trends, and the market. It can help you make well-informed decisions and, if necessary, modify your financial plans. Seek professional advice. Economists and financial advisors, for example, have in-depth knowledge of economic indicators and their possible effects on financial stability. You can protect your investments and company from needless losses by consulting with them for advice on how to create effective risk management strategies and make better financial decisions that are in line with your objectives and risk tolerance. With all of these, you should be ready for any economic downturn. Economic depressions and recessions are tremendously harmful to the economy and the advancement of the economy. Depressions are a rare event that can be very costly to society, but recessions are frequent and often impossible to avoid. Although some of Robert Kiyosaki's forecasts came true, this does not mean that all of them will. It is not yet clear enough to be deemed an inevitable fact. Instead, the Fed might see it as a direction to continue battling economic problems. If you enjoyed this video, like and subscribe. Don't forget to turn on the notifications to keep up with our upcoming content. Check out our next video right here.